Hello, this is Connie, your Accounting 1 instructor. Let's talk about Chapter 1 and financial statements. The first financial statement is the income statement. The income statement, if you follow along with my arrow, is calculated by revenues minus expenses. Revenues and expenses are the only type of accounts that are on an income statement. Revenues would represent such things as sales for a retail business, like JCPenney's. It might be expressed as fees, fees earned, professional fees, for example, by a doctor or a lawyer. Now let's assume these dollar amounts were given to you. So any type of fees, such as fees earned or any type of other revenue, would be listed first. Now the first number in each column needs a dollar sign. So notice I listed any revenues on the right with a dollar sign. The first expense needs a dollar sign. After that, they just have commas. Your expenses are listed from high to low. Only exception, miscellaneous expense, no matter how much it is always listed last. Now, it's an expense if it has the word expense after it. You add your expenses together, and I got $21,000 over here. Now to get your net income, it is $30,000 minus $21,000. Do not add. That gives you $9,000. You dollar sign and double underline it as it represents a total. Now notice that this $9,000 is brought down to the statement of owner's equity. We'll talk about that in a moment. The next statement is the statement of owner's equity. Now let's assume the beginning capital was given to you on January 1st at $45,000. Again, the first number in each column needs a dollar sign. We list it over on the right. This is an existing company. Let's assume no additional investments. So therefore we go right to net income of $9,000. Let's assume withdrawals were given to you. So less withdrawals. It is less withdrawals. So $9,000 minus $4,000 gives you $5,000. Please do not add here. Now for your ending capital, it is $45,000 plus $5,000. So your ending capital, or the balance on December 31st, is $50,000. Now again, the first number in each column has a dollar sign. The rest just have commas. And your total has a dollar sign and double underline. Now let's move on to the balance sheet. That $50,000, your ending capital, is the capital that we bring down to the balance sheet for the capital under owner's equity. Do not bring down $45,000. That is the beginning capital, not the ending capital. Now the rest of your information is divided by assets, liabilities, and owner's equity. Assets are things that your company owns that has value, such as cash, AR, account receivable, or in other words, money that people owe you, supplies. It's an asset until you use it up. Other assets might include equipment, land, auto. They would all be considered assets. Even if you have a loan on them, they still are an asset. You would total your assets. Now again, a dollar sign on the first number, a dollar sign and double underline on the total. 90 plus 20 plus 2 gives me 112. Now liabilities is money that you owe other people. AP here is accounts payable. That could be maybe for a utility bill or something you bought on account. Wages payable, unearned are all liabilities. Let's assume that number was given to you, just if we assume these asset numbers were given to you. We brought down the ending capital. 62 plus 50 gives you 112. Again, we need a dollar sign on the 60, a dollar sign and double underline on the 112. Do not put any underline on the 62 because you're adding it to the 50. Thank you very much for watching my video on financial statements.